Welcome back, IB Economics students, to this video lecture. I'm going to be graphing taxes. I'm going to be graphing indirect specific taxes. What does it look like when we put it in graphic form? So indirect specific taxes refers to a fixed amount of tax burden placed on a good, okay? So this means the tax quantity is fixed, and therefore the slope is exactly the same as the original supply curve is going to be. So like any other graph, we first start off with the demand and supply axis. Of course, the y-axis is going to be the price. So we go to price. And the x-axis, we're going to put the quantity. And for this title, we're going to title this taxes graphed. Okay, quite straightforward. So the first thing, we have to draw the supply curve. Okay, so the supply curve shifts upwards. Perfect. So this is our first supply curve. So we're gonna title this as S1. Okay, S1. This is our first supply curve right here. And secondly, we have to draw a demand curve. The demand curve slopes down because at higher prices, the quantity demand for a good is decreased. Okay, so this is our demand. All right. Now that we have these two, the next thing is for us to draw the tax or supply curve after the tax. So we know that specific taxes will increase the supply curve's price at any given quantity. So therefore, the entire supply curve shifts upwards like this. Okay, let's make all of these lines a little thicker. Around 3. There we go. So how do we and we name the second supply curve as S1 plus tax. Okay. So now that we have all of our curves identified, let us now get into what does the taxes actually look like. So drawing the first, or the original equilibrium, let's put some lines in. Okay, so these lines shows the correlation between the equilibrium points, or the old equilibrium points, with the new equilibrium points. Okay, so we can see that with the levied tax, the quantity demanded decreases because of the higher prices, and directly also because of the higher prices, the quantity demanded is the prices for the good increases. Okay, for the good increases. Now, how do we identify the burden? Okay, what is the burden of this tax on consumers? What is the burden of this tax on producers? And what is the gain, the government gain of this tax in total? Okay, so the first thing we need to do after drawing the equilibrium of points in both the old and the new is to draw a line between here. That way, we are able to identify this box, okay, this highlighted box. I'm going to put this highlighted box in yellow. So this highlighted box right here shows the total gain, the total government gain from the tax occurred. Now, how do we know which section is producer burden and which section is consumer burden? The top section with the intersection divided by the original equilibrium price. So this green box, okay, I'm gonna color this in. This green box refers to the consumer burden of the tax, and the box below divided by the original equilibrium point. This blue box right here is the producer burden. Okay, so for any tax graphs, you're going to be able to draw the consumer burden as well as the producer burden. Now, another very important thing to be able to identify is the deadweight loss. What is the deadweight loss? What does the deadweight loss refer to? This triangle right here. If you guys can see, this triangle right here. This triangle refers to the deadweight loss. Deadweight loss refers to the total welfare loss of this imposed tax. So I'm going to color this in. Yeah, gonna make it a little thicker. Okay, so this purple area refers to the dead weight loss. Okay, so I'm gonna make this purple as well. Purple as well. And this is, of course, the dead weight loss. So I hope this video is able to be helpful in showing how to graph the demand, the influences of the supply curve when a tax is levied, as well as the consumer burden and the producer burden, as well as the dead weight loss when a specific indirect tax is imposed on consumers.